Hello, and thank you for tuning in to episode 3 of our podcast series, Source of Truth, sponsored by our friends at Solo. Today's episode is a little different. So far in this series, we've been talking theoretically about the challenges posed by the data infrastructure that we've inherited in the U.S. financial system. These conversations have provided a great background and context for understanding the problem, but today we're going to move from theory to reality. What are the most difficult challenges you face when building and scaling up a consumer or small business lending business? What hard lessons can be learned from overcoming, or in some cases, failing to overcome those challenges? And what do those hard lessons tell us about the future of lending and data infrastructure in the US? In today's episode, I ask 4 deeply experienced founders and operators these exact questions. Our conversations, while short, are deeply illuminating. You will hear war stories about the early days of well-known fintech companies. You will pick up insights and creative ideas for scaling up in our heavily regulated industry. And you will benefit from the frank admissions that these folks shared about the problems that they still haven't quite cracked and why they're so difficult to fix. In order, you are about to hear my interviews with the following fintech luminaries. Luke Voiles, CEO of Pipe and longtime small business lending operator and executive. Rob Frowine, co-founder and former CEO of Cabbage. Jill Sheckman, former global chief credit risk officer at PayPal and longtime credit risk executive at American Express. And finally, Brian Hamilton, co-founder and former CEO of One and now president at Coastal, a well-respected BaaS bank. Honestly, I feel like the lineup I just shared should be all the selling that I need to do to get you excited to jump into this episode. So without further ado, here is episode 3 of Source of Truth, with those 4 interviews starting with Luke. Okay, Luke, thanks for joining.
Thanks for having me. Excited to be here.
I appreciate you hopping on. Just for context, before we get to my main question that I have for you, can you just give a little bit of an introduction on yourself and your background for folks who don't know you?
Yeah, sure. So I'm the CEO of Pipe now. I've been here about 2.5 years, and Pipe is building embedded financial services for small businesses. And we do that by embedding in SaaS vertical platforms. So we're effectively bringing all of the banking features into the SaaS software. Before Pipe, I was the GM of Square Banking, which was one of the largest kind of alternative lenders using like small business data embedded into a platform to make it happen. So we did $5 billion a year of Square Capital. We had checking account, credit cards, savings accounts, instant transfer. We were in 5 geos. So pretty global kind of banking business. And we actually owned a bank in the US as well. So I only spent about 2 years there. But before that, I was at Intuit. Was there 5 years and got 5 years of leadership training, like mission and purpose-based leadership training. And I got to help build QuickBooks Capital from scratch. So I went from 0 to, 2.7 billion a year in loan volume. So got a ton of learnings from Intuit. And like that was my tech career. So almost a decade of tech stuff. Before that, I had about a decade of distressed credit investing. So I bought everything you can imagine, like all the consumer lending stuff, mortgages, commercial real estate loans, all the small business stuff like MCA and factoring and term loans, like everything you can imagine, and all the crazy cash flow streams that people have never even thought of too, like all the special sit stuff. So a lot of like distressed credit and understanding assets and all the risks on the regulatory side and on the credit side, plus now tech. So that's actually a pretty good fit for what I do here at Pipe, which is like embedded financial services for small business. So that, like knowing how things go wrong is super important when you're building this stuff.
Well, that's actually a perfect segue to the question I wanted to ask, which is, having spent time on both the tech side as well as the credit side, and now obviously working in small business lending, embedded small business lending, what is one hard-earned lesson that you've learned about small business lending from all of the experiences that you've had, including now building Pipe?
It's so interesting. Like, I think it all comes down to the data. I guess it's really 2 things: the data you're using for risk and underwriting, and the actual customer experience you can get to are the 2 main things. So on the data side, I went into it thinking, oh my gosh, we have all of the data and we have all of the customers. Like we can go do this amazing, massive factoring business where the customers send $2 trillion of invoices. Like that's air quote send, like $2 trillion of invoices. But when you get there, you realize, wait a minute, these aren't sent invoices. These are just general ledger entries that somebody manually entered into QuickBooks and said, hey, I sent this invoice and it's an entry. Like if you want to see like how many invoices actually got sent through like QB invoicing, it's like a way smaller number, right? And so those invoices actually get sent out. That's pretty great. There's still a lot of them. And then you realize, oh wait, like of the ones that are actually paid on their rails, it's even a smaller number, right? So like you have like that's just a quick lesson in that you have these assumptions about data. You think it's one thing, and when you actually use the data for the risk purpose or for a purpose of showing insights back to a customer, then and only then will you realize how wrong you actually are most of the time, right? And so like getting to that layer where like, oh crap, like this data is not that great. Like it's like we can't do factoring. We're going to have to do a debt service coverage ratio underwrite on this population, right? So DSCR is basically like how much excess cash flow do they have to afford the loan payment every month. And in order to get to that one number, you need to know all of the revenue and all of the expenses. And so now you start thinking, okay, like, is this data accurate? Is it good? You have all these accountants using QuickBooks. What you realize is that, oh, wait, only maybe 15 or 20% actually have accountants using this, like using it and checking the numbers. So 80% of the stuff is like user entered garbage, right? Okay, that's kind of scary. Can you really lend based on data like that? Probably not. And so then you have to go to the bank data. And with the bank data, you at least know that a financial institution moved the money and has a record of moving that money. But what you have on that side is just a rolled up view, right? Like you can see that credit, like, so you can see that the Capital One bill was paid at the end of the month, but you don't know any of the expenses that they paid on that Capital One card. So you just lose all the granularity in the bank data. So you think all this data is going to be amazing and help you underwrite. Like the answer is, yeah, you can. You can build a massive business on it, but it's way harder than people think to like basically dedupe it and make sure it's accurate and like use it to get to like, I think this is the revenue coming into the bank account, not just a loan deposit, or like this expense is actually just a payment made out to the business owner. It's not really an expense. It's just a distribution like a dividend, right? It's like just knowing like when you see the money, you still don't even know what it's for. So I think my biggest lesson is that you've got to like in order to do amazing things in fintech, you need 100% accurate transaction level data, right? So then you go take this learning over to the Square side. And at Square, we did 5 billion a year in volume. We didn't need FICO score. We didn't need a consumer or commercial bureau of any kind. We didn't need the bank data at all. We only needed the credit card transaction history. Because you can narrow the risk problem to that perfect data set and then come up with this amazing thing for that perfect data set. But then you realize, oh, wait, like that's only 40% of the revenue of the business. Right. So we can only actually serve 40% of the business as revenues and only lend against that. So because you don't know what's happening off Square's platform. Right. And so like that's the like so but then you're kind of limited in the product you can do to only serve your own customers that are using a POS terminal from Square to process payments. So like you can get to accurate data sets, but nobody has the holistic 100% of every in and out transaction of these small businesses, right? That's part of what Pipe is trying to do. Like we have money in with our like partnering with PayFax. We're looking at AR automation to have invoicing and other money in. We have a card spend management and a bill pay solution. We're thinking about embedded payroll. If you get to a small business and have all of the money in and money out coming at the transaction level, like that's the holy grail, and that's what Pipe's trying to do too. But like for me, it's like to get to that accurate data set is the hardest part, and like assuming you can use it for things that you shouldn't be, like that's the other piece. So that's the first part of it. The second part is customer experience. If you have to ask them for stuff when they're coming through the funnel or the flow, you cause drop off. You cause drop off. And so that's why Square's product was so magical, is because you didn't use FICO. You don't have to ask them, can I pull your FICO? Because you don't use bank data. You don't have to say, hey, can you please link your Plaid account and pull this data? And like, remember what your password was. You get so much drop off in that flow too. And so when you get to a place where you know, like have the customer's perfect transaction level data, like that's the holy grail, and know all the PII where you don't have to ask them for anything. You get like a 3-click onboarding process. Like that's my lesson in lending. Like there's a way to do it. But like, there's a way to like so many different ways to screw it up too. And if you think you have data that says something different, like here's another great example. Like the whole world thought that e-commerce was going to keep going at the pace it was going after COVID. And so many lenders I've talked to have gotten like basically had to turn off their lending business because they made advances based on a future that never happened. Everything reverted to the mean. All of the vintages extended out to a long-term perspective, and they just had to kind of stop. Same thing happened on the consumer side. During COVID, all the stimulus checks came in, and everybody thought, oh, wow, these FICO scores are amazing. Let's keep lending. And you realize that the only reason why the FICO score stayed high was because it was subsidized by a stimulus check that allowed them to pay off a bill. And it caused the FICO score to go up. And then when all that reverted back to the mean, all of those vintages performed very poorly. So like another lesson in lending on data, you better have a grizzled credit veteran that can see through what all these like machine learning people think is everything and say, you know what, like I don't care what the model says. This doesn't make sense because this is going to revert and it's going to end. So like that's the other big lesson here is like you always have to have that grizzled credit veteran to like tell you to stop when you're stepping on the gas too much.
No, yeah, it's interesting because I mean, I think that you touched on a bunch of stuff that's really relevant to this series and relevant that I've been talking about, which is this idea that there are these trade-offs that we make between like making a great decision and being efficient, right? That's one of the things we've been talking about, and this idea that, you know, to your point, I mean, we saw a huge explosion in the 2010s of online small business lenders who were sort of taking volume away from banks, exploiting the fact that small business owners, and you and I have talked about this many times before, including on podcasts, they're very desperate to get capital when they need it, right? And so like efficiency and cutting out those steps, as you were saying, can be really, really important. But the problem is if you are accomplishing that by just skipping steps or by not asking for as much data or for trusting data that doesn't actually tell you what you think it tells you, you're not making good risk decisions, right? And so like there has always been this tension between the efficiency on the one hand and the quality of the underwriting, which is always based on that like nuanced 360-degree view of what's actually going on with this consumer or their business and their balance sheet. Like that's the only way to lend. We know how to do that. We've known how to do that forever. But the balance between efficiency in that experience and making a great credit decision, that's really hard, and everyone kind of bumps their head on that, I feel like.
Well, this is the challenge. For every specialty finance company, whether tech enabled or not, or every bank, like you can always drive more revenue by making more loans, right?
Sure.
Like there's always
you're giving away money,
on the CRO to make more stuff happen, and the credit team to say, you know what, we probably shouldn't do that right now.
Yeah.
And like if you divert too far off to the side of the marketing or the marketing team, you may blow the business up. And I've seen it happen many times. If you go too far on the side of the credit team, you end up like the banks and you batten down the hatches from a credit perspective, and you actually can't help these customers when they need the money the most. And so being able to balance it all and make the right decisions, like with the right data, even if you continue to make the right decisions, like using the right, or you think is the right data, you better double check the data, because we just talked about the FICO score that was inflated.
Yeah.
And if you just keep using that, it's a real problem. Like that's why Capital One is so good at what they do, because they just use the consumer bureau data as an input and get to what they think the actual view is. And they know where FICO score performs well and doesn't. They can actually serve massive populations that have low credit scores, right? So you actually have to have a more sophisticated, nuanced view than just taking data off the shelf. And all these fintechs that try to start lending businesses, like more power to them, but this is way, way harder than people think. And like, it's so easy to blow them up. And I've seen it happen so many times, even with the bigger ones. If you just get the wrong leader in there that pushes on the gas too much, that could be the end. It's not great.
No, it's absolutely true. One of the other ideas you're touching on that I want to just double click on real fast is this idea of like lineage with the data, right? Because I think that to your point, and the Intuit story is a great example. It's like, oh, we have all of this accounting data. Great. Okay, well, now we're actually looking at this accounting data. And it turns out that most small business owners are not trained accountants. And the data that's in the accounting system is, as you were saying, literally just, I haven't done the books for a while, but here are the last 6 invoices, and I just lumped them all together into one, and I didn't do any accounting treatments on that revenue. And like, but here it is, and we'll just put it in there. Like, it is self-stated data, self-stated by people who don't state accurate data for a living. That's not what they do, right? And so like that data, even though you have a lot of it, and even though like you should be able to extract some meaning from it, the quality, or as we've been talking about in this series, like the lineage of that data, where does it come from? Who is attesting to it? How can we trust this data? Like that's really limited. And then at the same time, even when you have what we'll call like higher fidelity data where you trust the quality of the data. To your point about the Square story, you might only be seeing a fraction of the overall business, because if they're using, you for point of sale, but a huge portion of their orders come in via e-commerce and they're not using your system for that, you have a problem. Or if half the money in is coming from these other sources that you don't see, like, you have a problem. And so comprehensiveness of data and understanding the full financial health and position of a business is just as important as the fidelity of the data as well.
100%. Like I have I don't know, I don't know, the way I think about data accuracy is that tier one data is where you actually move the money and have a record of it. Like you move the cash from one account to another, you have a record of it. That still could be fraud. It could be two fake bank accounts on the outside and some fraudster trying to trick you.
Sure.
But you've moved the money, you have a record of it. Like that's accurate. It's real. It's real. Tier two data is some other financial institution moved the money and has a record of it, which is like bank data, right? Or it could be Capital One, like Capital One or Amex transaction level history, if you can get that through Plaid 2 on the expense side. But like that's tier two data. You didn't move it yourself, but you trust the person who did move it. You think their records are probably accurate. Tier three data is anything that could come in through any other channel. And if you don't know where the data came from, and when we looked at data in QuickBooks, like we never tagged it, like whether it came, was it reconciled from a bank transaction or was it manually entered? I think they tag it now and are doing much better. But if you don't know the accuracy of the data, you're kind of done for. And like back to your like, how transaction level do you have? Like, yeah, Square had perfect data on that 40% of revenue, but you could also ask the customer, hey, if you link your bank account, you may qualify for more money, because at least you'll see the Shopify deposit coming in every day. You won't see every transaction level detail, but you can see some level two. You have tier one and tier two data, which lets you take a broader risk decision on some customers. So the challenge is gathering it all. But like when you get to when you think you've gathered it all, it is a known unknown whether you actually have it all or not. Right. Like, you know that you may or may not have all of the expense accounts linked or the revenue accounts linked. And so you can try to think that this is the full view, and the customer may tell you that, but it may not happen. And that that's the case.
Oh yeah. Well, I mean, we talk about this a lot, right? I mean, adverse selection is the enemy that we're all sort of battling against. And just to put a final point on it, then I'll let you go.
Sure.
I feel like as it relates to this concept of adverse selection, and this is the direction you guys have chosen at Pipe, a lot of it is about, all right, we're going to work with distribution partners. We're going to work with vertical SaaS companies that probably have the greatest right to know as much about their customers as anyone, right? Like, there's no guarantees, but if anyone's going to know every aspect of this business and be that close to the customer, it's likely this set of software providers, right?
100%. Like Square and Intuit were horizontals. They can't serve each industry that well, but Boulevard has an amazing experience for a nail salon or hair salon or med spa. Everything they do happens in one software now. So if anybody has the right to actually see all of the transaction level data, it's Boulevard. And they've added capital. If we can get them to add card and bill pay and payroll and all the rest of it, like AR automation, then you'll start to build that entire view out. And at that point, you can actually get to the financial OS for small business. Everybody's been trying to get to like that beautiful dashboard, now add AI, create the financial OS that can understand all this stuff. I don't think it's possible until you get all of the transaction level data. So you actually have to have all of the financial services attached to vertical, because if it's not vertical, they'll be using 15 different things and you'll never get full coverage. It has to go through vertical because they're the only place that business owners really trust, and will start turning on the other features over time and end up in a place where everything is happening in one spot. And if you have an AI agent that can tell you when you need to draw capital to go pay an invoice and just do it for you, that's pretty badass, right? And so that's what we're trying to get to.
I love it. Well, Luke, thank you for sharing a hard lesson learned from many years operating in this space. Appreciate it, sir.
Happy to do it. Good to see you.
Okay, Rob Frowine, thanks for joining me.
Hey, Alex. Pleasure to be here.
I am delighted to have you here, sir. Before we get to the meat of our discussion, I would love it for folks who are not familiar with your background. Everyone should be, but for those who aren't, can you introduce yourself and kind of explain your professional background real quick?
Sure, absolutely. I think the most relevant, my professional background, look, I was a lawyer for years. I've done a million different things. I think that's just the nature of being an entrepreneur. But in 2008, 2009, I started a company called Cabbage with two co-founders. And Cabbage, really a small business fintech that allowed small businesses to connect their data directly to the Cabbage system and allowed us to underwrite them in real time and serve them. We served about 250,000 businesses pre-pandemic, delivered nearly $10 billion in capital during that time. And then during the early part of the pandemic, we sold the company to American Express. And sort of all went over there at that point for a little while. So that's like my relevant background. I think lots of other things I could tell you.
Well, that is just by itself. That is hugely impressive and very relevant to our discussion. I was an avid cabbage watcher for years, so I am very glad to be able to have this discussion with you. The focus for this episode is trying to sort of get from folks like yourself a sort of hard lesson learned from building in the fintech space, particularly as it relates to data or data infrastructure. And as you described, I mean, and I'm sure you'll get into this in a lot more detail, small business lending is the perfect example of a place where there's all kinds of data challenges. And obviously, Cabbage made huge strides in allowing small business lenders to bring a lot more of their data to help make that process smoother. But what was sort of a hard lesson you learned building that out and scaling it up?
But there are data challenges, but there's also data opportunities because in consumer lending, you're much more constrained as to the data that you can use to underwrite a customer. In small business.
Right.
You have a wider opportunity to bring other types of data in. So that awesomeness, that great opportunity is matched with lots of challenges on the back end because you have small businesses that are, and look, we started, and interrupt me, please interject here, but we started in 2009, and I had noticed that there were a lot of companies that were opening up APIs to third parties, namely eBay, that allowed you to get direct access to data from third parties, from these sellers that were selling on eBay. A lot of people were utilizing that to help for logistics and delivery of packages and things like that. I thought, why not utilize that transaction data to actually underwrite a business? And so that was sort of the light bulb moment, if you will. I didn't think it was honestly that big of a deal. But I'll mention a couple of things and I'll pause because I'm sure you want to interject some questions. One is I wanted us to make sure that every customer that came on board gave us direct access to third-party data, confirmed data, as opposed to having some people come in manually and some people come in via API data. And that was because I felt like you needed that DNA, as did my co-founders back at that time. So you needed the DNA of a company that was going to use this alternative type of data. It would just be too easy if you started accepting data other ways. So that was a challenge, and that was something we decided. The other thing that was really important is because we acquired data the way we did, it fundamentally changed the product that we could offer our customers. So everybody out there was offering they would underwrite a customer a single time, give them a big, block of money, and then maybe they might serve them one more time during their lifetime. But because we connected directly into the data, we were able to underwrite that customer at that point of application, but stay connected to the data so that that customer could come back again and again and again. And we could keep a tally on how that business was going. So that's the good side. I'm happy to get to what the challenge was in doing that, which was your original question. But I'll pause there to see if you have any follow up on that.
Yeah, no, I absolutely do. I mean, I think that it's really interesting the way you describe it because small business has a much broader set of data that you can use as you're describing. But it does create these interesting questions around like, what should you use? What data can you trust? What's the sort of stack rank of data that's most useful? And then as you're saying, the persistence of the data and the ability to sort of use it in an ongoing fashion also really matters. So I'm wondering maybe if you can take us a little bit inside of the different types of data that you were sort of starting to look at. And you mentioned eBay as sort of an early unlock. I mean, it seems to me like there's data on the performance of the business. There's data on how the business banks. There's data on how the business does its own accounting of its operations and its financials. Like, what are the different levels you guys kind of uncovered when you were building this out?
Well, you raise a good question. Like, we didn't have a model at that point, right? So to us, all data was fair game. So we wanted to bring in as much data onto the platform as possible, not really understanding what the signals were. Um, Not all data is created equal, though, right? So if you have a span of small businesses running from restaurants to home services to, I don't know, small consulting firms and lawyers and doctors and things like that, some of the data overlaps, right? They all have a bank account, but a lot of the data doesn't overlap. You might have an inventory and supply system for, a small business that is selling goods and services, whereas you won't have that for a consulting company. QuickBooks is a good example of an accounting system that is used by a wide range of businesses, but every single one uses it differently. So the question is how do you rationalize data that, from a source that is used differently? Like if everybody calls a transaction something different, then it takes a long time for the system to really understand how to relate those two types of transactions and come up with something really relevant. And the challenge that it created is just relates to, at times, the inherent laziness of us as humans, which is we'll take the path of least resistance if it's offered to us, right? So, of course, everybody has a bank account. So we started bringing in all this bank data and we started writing all of our, that sounds awesome, right? Everybody's got a bank account, like you can look at it. You can create an income statement from the bank account. You can create a balance statement of sorts, cash flow analysis, those types of things. That sounds great. But my belief, and we never really got to this holy grail moment, but my belief was that just like FICO was an overused, too generalized representation of how a group of whatevers, consumers, small business owners, treat credit, and treat their debt obligations. I believe that if you just utilize bank data, at some point you fall into the same trap as you do with FICO data, right? Which is everybody's got, basically creates a score. And you're also basing it on one source of truth. And so my belief is the ultimate, which I wanted us to get to, but we never quite got to, was that we should use differentiated data first. For every customer, we should get to know each customer based on the unique data that they have rather than the common data they have. And then at the very end of the analysis portion, sure, throw in the bank data, sure, throw in the credit data, throw those things in, if you don't have enough of the other stuff, or even if you do, to just strengthen the overall model and draw some sort of relationship. But that to me is like the holy grail, right? Which is having access to all data, any piece of data that relates to how a business runs, and building your models based on that for segments of small businesses. Hard to do, easy to say, hard to do, maybe not that easy to say.
Well, it's a complex idea, but I'm glad you mentioned it because just to double click on it for a second, it's really fascinating to me, this tension that exists between these different things, right? Because as you're describing it, the ultimate vision of people being able to bring differentiated data about themselves, I can tell you, and you know this better than anyone having started Cabbage, that's what small business owners want, right? Like they want to bring everything they know about their business and the opportunities that exist around it to a lender, have the lender be able to understand it the same way they do, and then take a risk on lending the money based on that common shared understanding. And what's funny is, and I'm sure this was the challenge for you guys in trying to get there and never quite getting there, that's just a really hard thing to square with digital, fast, automated lending, right? Like those two things are just very difficult because that is functionally how like branch-based lending works, right? Small business owners don't want to go into a branch and they don't want to take time out of their busy schedule running their business to go do that. But like the old analog model of like go down, sit with your local community banker, like that is the ideal version of that you could get. It just takes too much time and it's too inconvenient. But then when you try to bring that into digital channels, and you did a good job describing earlier how you guys tried to sort of enforce some discipline around we're going to underwrite in a certain way so we can create this experience for our borrowers, then it sort of forces you down the path of more standardized data or more sort of over standardized data and scores, because even though that doesn't tell you everything about the business, it is efficient. And so there is this kind of trade-off between like the best way to underwrite an individual small business and the efficiency and automation that you sort of want to get to from an experience perspective.
I think you hit the nail on the head. That branch, so having that differentiated data, and when you use that example of the person walking into the branch, it's what you're saying is it's that relationship, right? They know you at a level that, an automated system conceivably can't know you. But if you can bring in this very unique differentiated data, into the system, you can argue that you can get to know the person as well as anybody else. And you're right, it's very, very, very hard. But, what I always told my team, though, is just because something's hard doesn't mean we shouldn't do it. Right. I mean, that's our job is to do the hard stuff. So our customer's job is easy. Right. And that's where there shouldn't be friction. Right. Which is, let's do the painstaking, really hard stuff. But I think we would have gotten there. And let me tell you, the promise of artificial general intelligence, not artificial intelligence, but artificial general intelligence, speaks to this concept of being able to take smaller amounts of differentiated data and draw intellectual, intelligence-based decisions off of smaller sets of data. And that's what really separates artificial intelligence that relies on large language models from artificial general intelligence that usually relies on world models or much smaller language models to draw conclusions, inferences, things like that.
No, you're right. I mean, I think about that a lot, right? Because the data exists. And I think, going back to your eBay example, like that's a really good example of, for someone whose entire business is built on eBay probably does know that customer, that merchant, that small business, as well as the kind of community banker working with the local business who walks into the branch. Like that, there's the same level of like relationship and comprehensive insight into that person. But as you're saying, the other challenge is extracting the data and reasoning through it in a way that humans are sort of naturally good at. Like a good loan officer is able to sort of like synthesize the data and what it means about the business. That for anyone who's ever built models around this stuff, you think it would be easy to build a machine learning model that can do that. It is not, especially the more sort of differentiated or unique the data is. It is really, really challenging. So I totally agree with you about AI being able to plug in there. Let me ask you one more question and I'll let you go. Once Kabbage had sort of scaled up and gotten to a certain point, I think the other challenge that we see, and eBay opening up their API is sort of an interesting counterexample to this, but you tend to see over time that for anyone who wants to lend money to small businesses or to consumers, especially in like a modern context, there's sort of a reluctance to share anything they know about the consumer with other potential competitors, right? And small business is actually a great example. It's not always great for the small business owner, right? Because like the small business owner needs lots of different types of capital. They need a small business credit card. They need a line of credit. They might need financing for purchasing equipment. And one lender might not be willing or able to do all those different types of lending. So there is a benefit to the small business owner in being able to sort of take their data with them or be able to sort of like work across the ecosystem to get the best product. But it runs sort of smack against the sort of natural commercial interests of any one lender who knows stuff about that customer. How do you think we're going to have to sort of navigate that tension moving forward? Because I see this everywhere. I see it in small business lending. I see it in consumer lending. I see it in the fights that are happening right now around open banking. Like everywhere I look, there's sort of this natural tension between those two things.
Well, look, I think once a bank takes data in and they do something special with it, right? They have their own risk models, their machine learning models. They have their own, customer service routines, and they handle things a certain way. That to me is the unique flavor of that organization. For me as the consumer, for me as the small business owner, when I provide my data to a bank, either during the application process or I transact utilizing their system, but those transactions are related to things I'm doing independent. The bank is the mere vessel of that transaction, right? Those transactions, I don't mind the bank leveraging that data, utilizing that data, continuing to build out new models based on that data.
Finding better ways to serve me, the business owner.
Yeah,
Right.
Figure it all out. But make no mistake, that data is my data.
Yeah.
And consequently, that data should be able to, if I am in favor of it, that data should be able to be shared and should be shared with other institutions that I want it to be shared with. And that should be part of the service that's provided by that organization. And frankly, I mean, I think the argument is, well, it costs us money. We've got to process it. I mean, there's a cost to wanting me as a customer, right? And charge me what you will for my credit card, charge me what you will for my bank account or not, charge me what you will for all those other types of things. And incorporate into that anything you think you need to charge me so that my data is free and my data can traverse to other organizations with whom I want to work. And by the way, then I'll make a decision whether I want to do business with you in the future based on your pricing scheme here, right? Whatever that may be. Don't create static or hurdles that, it reminds me of, the olden days when you had a cell phone number that was assigned by a cell phone company. They had you, like the service sucked, and they had you because you didn't want to have to go tell 3, 5, now 10,000 people, my new number. Like that to me isn't figuring out how to compete on the merits. That to me is using a gimmick to prevent competition. And so my view is it should be open. It should be able to be passed to other institutions. I should, of course, be aware of that happening. But if I apply to another institution, I would like my life to be easier. So that's how I would like to do it.
No, it makes sense. And to your point, like I think there's a huge gap between holding data hostage as a gimmick to hold customers versus creating enriched data or services that can help the customer navigate the ecosystem, right? Like those are almost two different visions of it. And I hope that as an ecosystem, we can evolve towards the latter one, where it's like, look, we want you to navigate the ecosystem. We want to compete on a level playing field, and we want to facilitate that process for you. And I think that will become sort of a new dimension of competition in the space. Rob, this was a pleasure. I could keep you for much longer, but I know you're a busy man, so I will let you go. Thank you so much for joining the podcast.
Thanks, Alex. I really appreciate it. Had a great time.
Awesome. Okay, Jill Scheckman, thank you so much for hopping on the podcast.
Thank you, Alex. Thanks for having me.
I am delighted that you're here. Before we get into the main question I have for you, I would love it if you could give a brief introduction to yourself and your background for anyone who's not familiar with you.
Sure. I have spent my career in lending, risk, payments, and data strategies really across consumer and small business portfolios, managing multi-billion-dollar exposures, both in the US and across international for companies like American Express and PayPal.
Fantastic. Well, you are just the right person to speak to then, because as you know, and as our audience knows, the focus of this episode is on trying to get some kind of hard lessons learned from the exact type of work that you just described, right? How do you build and scale a lending business on the consumer side, on the small business side? And particularly, like, where are the challenges in doing that from a data perspective, from an infrastructure perspective, from a technology perspective? So I thought we would just get a couple war stories from you while we have you. What jumps to mind as you think about that?
I mean, I have plenty of war stories over the many, many years and decades that I've been doing this. So I would say a lot of my work has really been focused on solving that problem. It's like, how do you make smart decisions when the data is just incomplete or unverified? That's one piece of it. And then the other piece is around data and infrastructure, even internally. So how do you integrate new data sources and tools and build great models with a really maybe legacy infrastructure. And that makes it really hard to sort of integrate. So there's a couple of things I would say, and this is really not a new problem. It's a really old problem that we've been trying to solve for many, many years. So think about on the small business side, you really want to assess someone's ability to pay, right? And their willingness to pay, right? And so you have consumer data, which, for small businesses tends to be very predictive. And that's, very traditional bureau data. But when you think about things like revenue, right? We've been asking for revenue for years. That's completely unverified, right? And so how do you verify that data? And so that's one piece of it. And then there's even identifying, there's no single source of truth for identity for businesses, right? So when you think about how do I even know you're a real business, like I have to go to each state and Secretary of State and try and validate, and I try and triangulate and think about, your web presence and how do I know what industry you're in? The data is so disparate and so inconsistent. So there's a few things like that I think about that we've tried to do over the many years, which is one is, how do you verify? Is there a verified source of that data? Two is, can you triangulate that data and try and use multiple sources to just try and verify that data? And then, you think about governance, is that, is it governed? Is it standardized in any way, right? And then there's also always modeling. You can always try and, fill in some of the gaps by trying to use historical data to model. So it's definitely a big challenge. If I think about more recently, like the exciting thing is there's so much new data coming in. But like I could take about like an example, like a bakery, like a small bakery. Like traditionally, we might ask that bakery for their financial statements, right? But those are unaudited, right? Now I could ask them for bank data, but sometimes that is definitely standardized, but difficult to use, right? Unless you have experience and you're one of the bigger lenders that has, real experience with leveraging bank data. But they may be, selling on Shopify, run sales through Shopify, DoorDash, Stripe, right? They have their books are on QuickBooks, right? They financed an oven through a BNPL provider, right?
Right.
And they might use Cash App, right, for deposits, right? So those are like completely disparate sources that you will not find in any traditional data source. So how do you sort of bring that all together and leverage it? And like what I've also found is that many organizations, like it sounds easy to connect all these data sources, but they don't have the infrastructure to leverage and standardize and then validate and model using all that data.
So that's really, really interesting. And I want to pull a couple parts of that apart for a second. So one of them is this idea that the data is like unverified, right? And I think there's like levels to that, I would imagine, right?
Yes.
Where it's like, okay, on the one hand, we can ask the small business owner for financial statements. We can ask them maybe even to like connect their QuickBooks account or get their accounting data. But, as I know you know very well, accounting data is really just whoever's doing the accounting's view of the business that could be non-standardized. It could be incorrect. It's not audited. Like it is a very loose view of a business's financials. It's not in any way standardized in a way that's really easy to use. So it's probably a little bit better than someone just filling something in on a form, but not that much better, right? In terms of getting this like verified answer. Then you get to different levels where you might look at like bank account data as an example. And to your point, bank account data has some things going for it in the sense that it is more standardized and there is a level of like baseline trust because it's coming from an institution that KYCs or KYBs this business or consumer. It's shared in today what is more of a standardized format. So like those are good elements to it. But even then, and this is where I'd love you to kind of chime in with your experiences, particularly at PayPal, like you still don't totally know or trust or have full visibility into the nature of the business, right? Like a bank account doesn't tell you everything about that business, nor depending on the bank that it's coming from, do you feel like you have a full visibility into what's happening. And I wonder if in the absence of that, where I see a lot of these platforms kind of build more certainty or more comfort is in first party data, right? And PayPal is a great example of this. Like, okay, we might pull in data from external sources, but the loans we're most comfortable making are the ones where this is a PayPal merchant. They have a history of transacting with us. And we don't need to ask them questions about the financials of their business because we actually see like the raw inputs, the money coming into the business in a way that very few other platforms see. So can you kind of talk about the distinctions between those levels of data?
Yeah, that's a great question. And I would say both at American Express and at PayPal, like internal data, once you have that customer, leveraging that internal data is key and is probably one of the biggest, predictors of risk and success at the end of the day. But, people's behaviors also change. You think about PayPal, they really service the online portion of a business. So if they have an offline version, they may also have another processor. And so
that's the thing that's frustrating about small businesses is they're not exclusive to any one provider, right? Like they're using Shopify, they're using Stripe, they're using Square, right? Yeah. So you don't have a full visibility. You have depth, but not like breadth, essentially, is the idea.
100%. So it tells you part of the picture. And that's where multiple data sources become important. So, you talked about, PayPal or Shopify or Stripe, anybody. And if you take that data, plus you have bank data, and now you're right, bank data, you might have multiple accounts, right? You might have multiple businesses. And so I think there's a couple of things one is there's a little bit of education that needs to happen with the business or the consumer. And we need to understand like what your primary bank account is. Now, the exciting thing I do find about bank account, if you get it right, and particularly for small businesses that don't necessarily have multiple bank accounts, like you can actually build a P&L off of your bank account, right? So if you categorize the data really well, which not everybody does, but if you do it really well, you can understand what is payroll, what is your cost of goods sold, what is your revenue? What is your overhead? Like, how are you paying your vendors? Like you can get to that level of granularity. And then if you think about, the PayPal example that you gave me, I can then go and triangulate potentially that bank and understand, okay, what percentage of the share of your till do I actually have by looking at this bank? And that really can help inform some of my decisions around, your cash flow and your ability to pay and your indebtedness and all those other things. So, it's now you have these, like I said, these disparate data sources and how do you stitch it together is really the big challenge. And I think that, some of the bigger financial institutions have been at this a little bit longer and are a little bit more sophisticated at it. But, the smaller guys don't necessarily have the right skill set or talent or even the breadth of talent to really be able to go out and try and triangulate some of this. So they do often rely on vendors to give them scores and to help them. But then you're like putting trust in a vendor to understand like your business, and it's a one size fits all approach, and you might have a very different product, and the tools that they're using may not be accounting for some of those differences. So it's a challenge, I would say.
Oh, totally. Well, and I think, it's an interesting one because as you point out, like it's just really difficult to standardize on stuff if you really want to like outkick your coverage from a lending perspective. And small business is probably the best example because it's so heterogeneous and every small business is very different from every other one. And it's very difficult to apply a standardized model on top of small business as a category. But even in the consumer space, I've been thinking a lot about the fact that like the very best lenders, and I've been looking at, like Capital One historically, or you look more modern in a more modern sense at someone like in a firm, like they very much underwrite a consumer on an individual basis. And in the case of someone like a firm, like on a transaction by transaction basis, like it's very tailored and it's very context aware. And, in that model, you really do have to have the infrastructure necessary to stitch together an approach that will work across lots of different sources. And I want to get your take real quick on, like, what is it about even working inside large institutions, right? Yeah, setting aside the really small guys who don't have the resources to do this. Even if you have the resources, like my experience working with large banks or kind of large incumbent fintech companies is a lot of silos, a lot of different processes, a lot of repeats of doing the same thing, right? Where it's like, and this is, I think, frustrating from the consumer or small business owner's perspective, where it's like, I just worked with these guys over here. Now it's a different division of the same company, but you're asking me for the same information. Like a lot of that seems to be an infrastructure problem, right?
100% it is an infrastructure problem, right? You said it perfectly. Like organizations totally operate in silos. So like the merchant onboarding team is completely different than the merchant lending team. And so you might have asked the information to verify the business at the time of merchant onboarding, but you don't necessarily carry that information over, or the systems are not able to talk and connect, or you might not even understand the lineage of that data to be able to use it. And so, yes, you are creating sort of these awkward customer experiences where seemingly on one side of the house, you really understand who the customer is in great detail. And then on the other side of the house, it's like you're starting from scratch and I don't know you at all. And so the ability to really, for these systems to talk across an organization is really super important. So, and you talk about AI a lot. I mean, this is also the big problem with institutions, is that they don't have the infrastructure in place and the data infrastructure in place to sort of bring all their data together in one place to really make those intelligent decisions. And it could be underwriting and it could be customer servicing, but having that data together and being shared across the organization and really understanding sort of the lineage and sort of trusting that data and being able to reuse that data is like the biggest challenges for the biggest organizations. And I think some organizations have been doing this for years and years and years, and have sort of evolved to a place where they can do this very simply. But I mean, legacy fintechs, I think some big banks, some smaller banks, they all struggle with legacy infrastructures and trying to modernize to create great new products and great customer experiences.
Yeah, I mean, people would be surprised, I think, from the outside how fast silos form and sort of legacy technology and tech debt sort of accumulates. And as soon as that starts to happen, it's really, really difficult to reel that back in. And your point about lineage is a great one as well, right? I mean, it's kind of a interesting way of framing it, but like if one division inside a lender doesn't trust the lineage of the data from a different division at the same company, how are they going to trust the lineage of data from external sources, right? If you can't even trust like a different division at your same company and you feel like you have to repeat all those steps with the consumer to get the level of context and comfort with the data and trust that you can do what you need to do, like broaden that out across the institution, it becomes a huge, I mean, it's really like a massive coordination problem. And apart from a few examples, like the credit bureau is very narrowly focused on repayment data, there's just not a lot of shared infrastructure for facilitating that like sharing of data and lineage. It's a tough problem.
Yeah. And then if you even take it one step further and you think about fintechs and the banking relationships they have, right? So fintechs may onboard a customer or a merchant or a small business, and then they might work with a bank because they don't have, they're not regulated. So they may work with a bank, and that bank might have a different set of requirements for onboarding or verification, KYC, KYB, underwriting, et cetera. And so again, it's a coordination problem, and it's somewhat of a trust and a understanding lineage. And so the lack of governance, and I think the lack of standardization, and I think trust in data all becomes a challenge, and it winds up being not a great customer experience. And I often think about this, like if there was more coordination, just think how easily you might be able to underwrite customers, right? With literally clicks of a button. You could pre-approve people beforehand. You don't have to re-ask information that you already know about that customer. Like you can really, if done right, create incredible customer experience, but also create access in many ways. Yeah.
Which is critical. I mean, and you've worked for a long time in the small business space. Like that's what small business owners say over and over again is I don't have access to as much capital as I need. So like solving that underserved problem on the consumer side and on the small business side is just incredibly important. Jill Sheckman, we could do this for a lot longer, but I know you're busy, so I will let you go. Thank you so much for joining me. This was great.
Thank you for having me. This was a fantastic conversation.
Brian, thanks so much for joining me.
Glad to be here. Thanks.
I'm delighted to have you. This, I think, will be a really fun conversation because I know you think deeply about these topics. But before we get to my question, I would love for you to just introduce yourself to anyone listening who might not be familiar with you and your background.
Sounds good. Currently president at Coastal, so I run our fintech division. We're a sponsor bank behind some notable fintechs you may know. Prior to that was founder at One Finance, direct-to-consumer fintech that was acquired by Walmart and is now the brand and product sold through all of their digital and physical channels. Prior to that, a couple of other companies, a neobank focused on small business called Aslo, was at BBVA and helped build out their open platform. So one of the very first generations of open banking and sponsor banking back in the day. Prior to that, I sold the company to Capital One. I actually ran small business for them digitally for a couple of years. So have seen the movie in a couple of different flavors on both the fin and the tech side of things. And it's been an interesting ride.
I imagine that it has been. We could take the next 90 minutes for me to ask you questions about everything you just described, but we won't. We'll stay focused. And I have one question, which I'm trying to ask everyone in this episode, which is about a hard lesson that you've sort of learned over your career. And specifically, I'd be very curious to understand kind of your evolving views or kind of what you found working both on the fin side and the tech side, as you described, particularly as it relates to like data infrastructure and how you think data infrastructure in the US and the financial services ecosystem needs to evolve.
Yeah. One that might seem obvious is that banks take forever to do anything, right? So they have these massive pools of data where theoretically they are able to share it for the purposes of risk and fraud mitigation and things of that sort, but they don't really, right? They still... The rise of, I think, a lot of the aggregators and data platforms that banks rely on are largely a result of the fact that they couldn't figure it out themselves, right? I think there's a reason for it, right? In the older version of things, running your own data centers and protecting all of your customers' financial data required very high walls and barbed wire fences and all of those things. In a cloud environment where it's all on somebody else's cloud anyway, I think they've been slow to figure out how to share that for good, right? Like I think very few of them are out there trying to sell customer data, for profit to marketing companies, that sort of thing.
Sure.
But even just to share data for the purposes of mitigating fraud or, true risk collaboration can't get out of their own way. And a lot of it is just the fact that most of the time they are large and slow organizations. They rely on legacy infrastructure, the FIS and Fiservs and whoever your core is as a bank. And I think that's one of the reasons fintech exists, right? I think they are able to better solve the direct to consumer user experience problem or the data aggregation or data collection problem. And a lot of it just goes back to the fact that they're big, slow organizations, right? So it seems obvious, but it is a painful learning. If you've ever tried to sell software to banks, if you've ever been inside one, pre or post acquisition, you realize the pace is just different. So obvious as it may seem, it's a learning.
No, of course. Well, and I want to ask you about the fintech side of it now too, right? Because obviously you're at a bank, you work with a lot of fintech programs. I think one of the things people aren't maybe thinking about enough as this ecosystem evolves is fintech companies are sort of evolving into banks in a lot of ways, in the sense that they're large companies that work with lots of customers directly. Some are eventually going to acquire their own banking charters, some are not. But like for the purposes of like data infrastructure, one of the things that's really interesting to me is that fintech companies are going to become data providers as well, right? And I'd be really curious to get your take on how you think that might look or work, and maybe how it's going to be different than what we've seen with banks before. Because as you said, I think on the one hand, banks are very slow. They don't, I think, historically have thought as much about their data as an asset the way maybe that fintech companies or tech companies do. But at the same time, I also think it's a fair critique, and we can pick on, I won't name them, but other banks that have operated in the banking as a service space that maybe haven't done a great job, that, some of the data being provided, it's not all made the same, right? Like these fintech companies that might be data providers or working with consumers, like they might not have quite as many reps managing risk, verifying credentials, like doing all of the things that we sort of trust banks to do. So how do you think that's going to evolve as fintech companies get to a scale where they become significant data providers in the ecosystem?
I think that's an astute observation, right? I think if you look at the banks in the sponsor banking space, there's basically three categories today. You have those that started as kind of an API platform and they're learning how to be a bank, right? They were one from the start. You have those that are that really invested in and were deliberate in getting into the business, right? And they are now having to reinvent their entire data architecture to essentially become data companies. And you will either get there or you don't. And if you don't, you won't still be around, probably. And then you have fintechs who themselves are getting banking licenses and will be a bank. But they were a scaled fintech prior to the licensing component. But in all cases, you're going to be a data company at the end of the day, right? Like you will either be good at it or you won't be here anymore. And so we're talking about a specific class of banks, obviously, not the legacy mega banks, the JPMCs and BofAs of the world, but folks that decided to intentionally be a banking as a service or a sponsor bank provider to these fintechs. The reality is you won't survive in that world unless you are a data company in the coming years. Because that is essentially what you do, right? The money is already ones and zeros. How good you are at that, how much you understand that, the additional products you can build on top of that, and how well you can serve fintechs on the front end. I mean, it is inevitable. You mentioned there are a few banks that were kind of tourists in the space and or really dove in and tried to do too much and were not good at data, were not good at reconciliation, maybe made some bad choices with partners that sat in between themselves and fintechs. And we've seen at least a couple examples of where that can go horribly wrong. But it is... it's an evolution. And I think if you look at what's happening with data, like if you don't have an environment that you have purpose built with the intention of running things like AI tooling on top of it, it's not going to work, right? Like you can't just throw it on top of your old stuff and have it magically work. And I think that's the fintechs have figured that out. The advantage of a banking license depends on what business you're in and whether or not it's really worth it. The grass is not always greener on the other side. If you're a fintech and you want a banking license, you may or may not like that years later. If you already have a banking license, you are going to need to reinvent your entire architecture as if you are a fintech, if you want to play in that space. And I think it's all happening quickly, right? Obviously, AI is accelerating. Like all of these forces are accelerating at a pace that even in the first kind of fintech 1.0 revolution, we're moving slower than they are today.
No, that's absolutely true. And I'm glad you mentioned AI, because it's the last thing I want to ask you about real quick before I let you go, which is, obviously a lot of the stuff that we're talking about, right? It either fits into the category of easily structured data that's relatively straightforward to deal with, which to your earlier point does not mean that everyone in the ecosystem is great at extracting value from it, but at least it's like relatively easy to deal with. And then there are the sort of realms of data that is much more difficult to deal with, right? And you used to work in small business lending, small business banking, like this well. There's a lot of categories of data where it's just very unstructured, or there's lots of different edge cases and things that make it difficult to deal with. I'm curious how you think about changes in technology, particularly AI and large language models, and how it might change the way in which institutions sort of wrestle with and extract value out of data?
I mean, I hope it changes it substantially and quickly. It's a hard problem to solve. I think ultimately one of the things that regulated institutions are challenged with, and to some extent fintechs, because they're either pseudo-regulated or formally regulated. They made themselves a broker-dealer or a bank someday or whatever it might be. It's the certainty, right? Like if you have a huge pool of unstructured data, AI swimming around and they're making sense of it for you is actually really important, right? Like that is much more effective than the way you used to deal with it. And then you need to prove that the answer you got from that is right? Like there can't be 1% hallucination in the outcome from the model if it is what is your bank balance at the end of the day, right? It needs to be 100%.
Right on.
And so I think one of the biggest challenges is that certainty that comes from, the requirement that you get it 100% right, which is forced by a regulator or some, auditor or examiner of some kind. It can't just be 99% right. But you should still be figuring it out, right? Which if you're not applying it to those large unstructured pools of data, then you're getting it 50% right and spending 10 times as much time doing it. That's still worse than getting it 99% right. But when your examiner shows up, it has to be 100% right. And I think if you get the structured data right on the way in the door, which is kind of the phase we're at now, right? Which is, structuring it, having solid data lineage, having everything be reliable and, in the right format, and what you have, you can run AI on top of that and get a ton of advantage. Right? If you have a big pool of unstructured data and some insights come out of AI that you run on top of it, but then you have to prove to somebody that those things are 100% correct, it's a harder problem to solve.
Yeah. No, it'll be interesting. I mean, that's kind of one of the themes of this entire series is like lineage of the data, right? And building a solid foundation to build on, right? And to your point, particularly as it relates to bank balances or credit decisions or these kind of key components, the reason this is hard is that it can't be 99% right. It has to be 100% right. And you have to have that level of confidence that you can tell your regulator or your supervisor, like, this is right. We stand behind this. Brian Hamilton, I could keep you for a lot longer, but I will let you go. Thank you so much for hopping on. This was great.
Yeah, it was fun. Thanks, Alex.